Welcome to the Interaxis channel and Interaxis.io. We're going to keep talking about some of these major building blocks we have in the crypto world, in the blockchain world, in decentralized finance, and in this video we're going to talk about derivatives. First, we want to remind you that we keep creating more videos, more content, more education like this, and we want you to be able to see it when it first comes out. So please subscribe to the channel here. Let us know what you think. Give us some comments there. Ask questions, whatever you want to do. Follow us on Twitter at Interaxis8. We hope to see you there. But right now, we're going to talk a little bit about derivatives and how important they've been in the crypto world and in the decentralized finance world. So first thing we have to discuss is, what is a derivative? Okay, a derivative can be something like a futures contract or an options contract. Okay, and there are really ways that we can that companies utilize to potentially hedge. There are ways to control or gain exposure to large amounts of some sort of an asset without actually having to own that asset. There are also ways to control things like cash flow. That's what a lot of companies do. They can control cash flow, they can control profits, they can control earnings this way by utilizing options, futures, and other types of hedges. So real quickly, how do they work? We'll take options first. Okay, so an option is just that. It's giving me the option. So we'll take an options on, we'll call it oil. We live in Texas, so we'll talk about oil. So let's just say that oil is trading for $40 per barrel. Okay, and we have as always, we have Adam and Ron. And we'll do what's called a call option. A call option means if I buy the call option from Ron, I'm buying the ability to purchase oil from Ron at a certain strike price on or before a certain date. Okay, so if let's say it's a $45 option, $45 strike price, and we'll call it whatever, October. Okay, so I am buying the opportunity. I'm buying the option to purchase barrels of oil from Ron at $45 on or before a certain date in October. So why might I do that? Here we are, currently it's August, and I might want to do that. Well, if I think the price of oil is going to go to $60 a barrel, okay, I might buy this option, and that means at some point, if the price of oil goes up to 60, I can then buy it from Ron at 40. I can sell it on the open market, sometimes called the spot market, at 60, and here I profit $20 for every barrel of oil. Now, why might Ron want to sell me that? Maybe he doesn't think oil is going to 60. Maybe he doesn't care. Maybe Ron bought oil down here at 25, and he's pretty happy if I call him out at 45 because he's made $20 a barrel already. He doesn't want to take any more risk. Now, what do? I see the difference here is oil is currently at 40. I'm buying the $45 call option. So I have to pay some amount of money. I have to pay Ron for that ability, because the risk that Ron is taking is if oil does go up to 60, he doesn't get to participate in that, but he gets to make money. So if I pay $10 for this particular option, that goes to Ron, and he makes another $10 on every one of these options contracts. Okay, so why might people want to do this? Well, obviously there's the profit motive, right? If I just speculate, if I run charts, whatever it is, and I think oil's going to go to 60, well, I'm willing to pay a little bit for this option. I'm willing to pay $10, and as long as oil gets to above $50, essentially, I make money. Right? If oil actually has to get to $55 in this case, because I have the $45 call, plus I paid $10 for each one, so as long as oil gets above $55, I make out in this case. Okay, so there's just the trading, the profit mechanism. Okay, the other reason I might want to do this is if for some reason my business relies on this. So Ron might want to do this. Ron might want to sell this call option because he might be in the oil business and he might have all this all this oil that he's either drilling or what have you, and he's trying to kind of normalize his books. He's trying to normalize his income because businesses like oil companies and such are not in the business of speculating. They're in the business of making a certain amount of profit, and they don't want to take too much risk. So they use options and futures and such to kind of guarantee some of their profits. We've actually seen in the past where transportation companies like airlines have actually purchased futures or purchased options like this when the price of oil or the price of gas gets really low. They've purchased long-term futures or long-term options like this because that way they can make sure that they keep their gas prices low. Because one of the big drivers of profit, one of the big drivers of expenses in airlines is obviously the cost of fuel. So if the cost of fuel is currently really low, the cost of fuel is down here, and the airlines can go, look, we're going to lock in this price for a year and a half to come, and later the price goes up, well, they can base their ticket prices on this price here because they know they're going to get this price locked in for 18 months to come, and they can undercut a lot of the airlines that might not have done this. So it's a way to look at their balance sheet, to look at how they make money and kind of normalize some of that and take advantage where they can. So because the airline is not in the business of speculating on gas prices. They're not in the business of speculating on fuel prices, but they know it's a big driver. So what can they do to hedge that if they can? Because they don't want to have ticket prices that go out 6 months or 12 months and all of a sudden the price of fuel goes up and now they're losing money. They go, no, we need to set our ticket prices now, so we need to know exactly what our cost is going to be going forward. This is how options and futures are used in the traditional world. So what are we seeing in the blockchain crypto world? Well, we've already seen in the blockchain crypto world things like Bitcoin futures. Okay, so it's a way to on the Bitcoin futures, and I didn't really talk about futures, but Bitcoin futures or any type of futures is somewhat like an option, but it doesn't give me the option. It basically says, I will sell or I will buy this particular asset from you on a certain date. I will actually take delivery of it. Okay, so it's not I have the option to do it if I want to do it, if I don't. The future is I will, on a certain date, take this particular asset from you. So Bitcoin futures we saw as just another way to gain exposure. And what it does is it gives me the ability, if Bitcoin is say at $10,000, it might give people the ability to control more Bitcoin on one side or the other without having very much money, so they can leverage their money to be able to control more Bitcoin. You might see Bitcoin miners utilizing Bitcoin futures so that they're not 100%, so that they can lock in some of their future gains, right? So if they're mining Bitcoin right now, they can have futures contracts potentially out 3, 6, 9, 12 months that say they are going to sell it here for $12,000. 14, 16, etc. Now, most Bitcoin miners, of course, would love the price to go up. But if they can lock in and say, we know how much Bitcoin we're going to produce, and therefore we have contracts in place to be able to sell it at these certain times to someone else, we've already locked in our profit. And even if the price of Bitcoin goes down to $8,000, or if it stays right at 10, we've locked in this profit. And these other companies on the other side of the equation, well, they've probably lost money there, but they were willing to take that risk for some reason. So you've already had Bitcoin futures because Bitcoin has kind of become an asset unto itself, and it's a really important point to note, because that is what has given us this Bitcoin as its almost its own asset class. The fact that we have derivatives, we have futures, we have options, we have lending capabilities. We've talked about this, the custody that's been generated. The fact that we have all these other instruments on top of Bitcoin is what makes it a viable asset class. So now we need to talk about the potential for something like decentralized DeFi derivatives. Okay, so I hope this all has kind of made sense so far. But now we have the DeFi derivatives. So in the decentralized world, where do we see options? Right? Where do we see potentially futures? Where do we see other ways to hedge? Because that's what it really becomes in here is, are we giving ourselves the ability to hedge? And are we hedging only in the crypto world, or are we hedging also the traditional world? And that's where we see some of these derivatives kicking in. Okay, so in the derivatives world, we have, we can build things like 2x ETH derivatives. And what does that mean? That means for every we'll call it $1 that ETH goes up in value, if I have a 2x ETH derivative, if I own that, and it's probably a token that's been created that is a 2x, it will go up $2. Okay, well, how does it do that? Basically what I'm doing is I'm potentially I'm locking up my ETH, or I'm locking up my DAI or whatever to buy this 2x ETH, but it's a smart contract that can be liquidated at some point. So it's essentially, I have to create this smart contract where it has some collateralization, essentially, that says if 1 ETH is trading at $400 and I have a 2x ETH, if the value of ETH gets below, say, $300, this is going to be liquidated. This particular 2x is going to be this position is going to be liquidated, and I'm going to get my ETH back. Okay, and that's how they can create the 2x. It's just smart contract enabled, algorithmically enabled. That says this particular token right here, based on some oracle, which of course we've talked about in others, based on some price oracle, is going to go up twice as much in value as the value of ETH goes up. Okay, so those are some derivatives, and a lot of that is kind of trading based. It started out as kind of trading and fund based, but what we've seen is it's developed these ways for us to have different types of asset management based exposure. So let's say I just have 1 ETH here, but I want I want the exposure to ETH, but I also wanted to participate in a liquidity pool, for instance, right? So what I can do is I can take this and with like a quarter of it, I can buy a 2x ETH derivative, and with the other 75% of it, I can go into some ETH maker pool that's giving me some sort of transaction fee, some sort of LP fee here, but I still have exposure to the value of ETH going up in price. So I have the value of ETH going up in price here, I have 2x here, so I still have a very similar exposure if the value of ETH goes from 400 to 500, but if the value of ETH stays right where it is, I'm still getting this fee. So it's a way for me to participate in the full upside of ETH while still getting some sort of fee. So that's a way that we've seen it, where we've talked about the financial architects that are able to do this, and Zapper was one of the first that we saw that was able to take some of those derivatives and package them together and give me the ability to get full exposure plus to get some sort of liquidity provider fee. And now we're seeing that even more when we talk about things like yield farming. Okay, where else are we seeing derivatives being used? Well, we're seeing the ability to take positions, like if I have a bunch of, if I have 5 ETH, we'll call it, and I might be contributing to different liquidity pools, whatever it might be, but I need to take a hedge on the other side. I need to take some sort of option on the other side that if ETH goes down in value, I might have some lending out here. I might have some vaults, some maker CDPs, some other liquidity mining that I'm in, and if the value of ETH goes down, maybe I get liquidated. Well, what do? I come out over here and I buy some sort of hedge. Okay, and this could be, we've talked about things like Open, Hedgic, and some of the others that are out there that are able to hedge against the downside. And now what I can do is I can, maybe I can sell calls, or I can buy put options. And a put option gives me the ability to sell a particular asset to someone at a price. So I might have a put option here at $350 that says if the price of ETH gets below 350, I can sell my 5 ETH to someone at 350, and maybe then I can keep these all these positions from being liquidated because I can add liquidity to them. Okay, so what I'm doing is I'm utilizing them to hedge my bet, to hedge some of my investments. But of course, all that is all within the crypto world. Now, this is where it starts to get really fun and exciting. Is you have synthetics, you have UMA, and some others that are able to give you the ability to create synthetic assets. So what could those be? That could be synthetic. Of course, there's synthetic USD, and UMA has created some of this. But you can see where you can have like an S&P 500 synthetic. UMA, I know, has given us the ability to create synthetic S&P or synthetic stocks and such, synthetic Tesla, Apple, whatever it might be. Now it gives us the ability to not only have exposure to it, but also hedge against it on the other side. So an example I might give is, as I say, I'm in Texas, right? If there's a synthetic oil token, there's a synthetic oil hedge, and maybe there's an inverse synthetic oil hedge. And I don't know if this would actually be the nomenclature for it, but an inverse synthetic oil hedge. And I'm in Texas, and I have exposure by virtue of my business, by virtue of my life, whatever it might be. I might be able to go into the Ethereum, into DeFi, and I buy this particular token. And if the value, the price of oil goes from 40 down to 35, yes, this hurts my business, it hurts my life, whatever it might be, but this actually goes up in value, and maybe it makes up some of this difference in here. So the idea of derivatives, whether it's futures, whether it's options, whether it's synthetic assets, options on synthetic assets, whatever it might be, is really important. And it's not just important because people want to profit from it or speculate or something like that. It's important because it gives us so much more ability to, within the decentralized finance world, hedge our life, hedge our financial life, hedge our financial business, hedge some of the other exposure we have, so in the past, when cryptocurrency has been all about wild speculation on the upside and on the downside, and we only have long and short, well, now what if we have long 2x so that I can get some exposure somewhere else and get some income? What if I have call options or put options on some traditional asset, because in the real world I have exposure to that asset? Well, why would I want that in the DeFi world? Why would I want that exposure? Why would I want that hedge in the DeFi world? Because it's just easier, right? It's easier than setting up some sort of account to get some inverse oil to sell call options or buy put options on oil. That is cumbersome. There's a lot of KYC that goes into it. There's just a lot of work that goes into it. It's much easier, potentially, not necessarily safer because we know there's technology risks and such, but much easier to just say, hey, I'm long oil in my life for some reason. I'm long gold in my life, whatever it might be. I'm going to short it in the decentralized world. I'm going to create a hedge for it in the decentralized world, and we're going to see so much more of that, especially, and we'll talk about this when we put everything together, but if we're talking about trade finance or something, or we're talking about insurance, we're going to be able to utilize some of these. I can build hyper customized portfolios based on my my investments, my financial world that says I'm going to potentially buy some real estate or real estate tokens in a certain part of the world, but then I can use some of these synthetic assets or some of these hedges or some of these derivatives to help me hedge or help me create some downside protection risk, because I might not be able to fully buy insurance against whatever that risk is, but I might be able to hedge that risk. If I buy real estate or real estate tokens to represent real estate in the Texas area or in the Arab world or something, and I want to hedge that by buying this inverse synthetic oil, I don't have to go to a traditional brokerage or someone and start selling or start buying put options on oil. I can just go here, buy the inverse synthetic oil token, and now I've hedged some of my other portfolio. Again, I can create these hyper customized portfolios, not only for my investment portfolio, but for my business and for my life. So that's where we see derivatives really kicking in. It's going to give people the ability in the decentralized world, with the composability, with the cross-chain ability and everything, to really hone their financial life, really take care of a lot of the hedges, a lot of the risk, a lot of the insurance they need. And that's where we see derivatives both outside of the DeFi, the traditional DeFi, or the DeFi, the Ethereum DeFi world, things like Bitcoin futures and such, lending credence, lending professionalism to that market. But then within the DeFi world, eventually with these financial architects, with the work that's being done, we're going to be able to create these portfolios and these hedges for portfolios and these abilities to earn more income or limit your downside by use of synthetic assets and by use of derivatives. Okay, so that's a little bit about derivatives. We'll talk more about it when we put everything together. We want to talk about some of the building blocks that are being done. Check those out. We hope you enjoyed this video. Please don't forget to subscribe. Tell us what you think in the comments. Don't forget, follow us on Twitter at Interaxis8, and we hope to see you in the next video.